when it comes to making an acquisition. And if the numbers don't work, and if we can't raise a proper amount of reserves when we're going into a deal, we don't do the deal. Technically, reserves will actually diminish your IRR, because you've invested too much, but nothing will diminish your IRR like giving the property back to the bank.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Stewart Heath is the founder and CEO of Harvard Grace Capital, a private real estate investment firm that helps people build wealth faster through hands-off real estate investing that generates passive income, reduces risk, and maximizes tax efficiencies. Stewart, welcome to the show.
Thank you so much for having me. It's really an honor. Thank you.
Absolutely, Stewart. The pleasure is mine. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Where I started with one duplex in Franklin, Tennessee, that was in the middle of the hood, and just sort of fell in love with it. And from there, 2 years after that, I had 50 rental units, and just in all honesty, sort of had hiccups and sort of gave it all back to banks in the year 2009, but have come back and focused primarily on commercial real estate, which is where our focus is right now, on asset classes such as office. I know that sounds crazy, but and self-storage, and we keep poking around multifamily, but we haven't found that deal yet that we where it's priced like we like it. So that's where we are today.
Got it. 50 units in 2 years. You sound like somebody that likes to rest on your laurels.
Yeah, we actually got that up to over 220 personal units that we owned, and in the midst of doing home construction and office development, and everything was great until the middle of 2008. So that sort of changed the world a little bit like COVID did. This generation. So.
It most certainly did. And this is going to sound like a cliche question, but I want to hear it straight from you. What are things maybe that you've done differently in the way you build your portfolio now? Yeah. Maybe, especially with kind of the changing interest rates and everything else we're looking at. I mean, there's a lot of macroeconomic things right now that people are kind of scratching their heads about.
Yeah, there really are. So the biggest thing that I've learned from going through what I went through was the necessity for reserve. It almost sounds cliche, just like the question, but I mean, I'm a CPA. I knew better, and I had literally built up a portfolio of $20 million in commercial and residential real estate, with a net value of over $10 million in that. That's all based on appraisal, and but for the lack of, call it, $500,000 in cash reserves, I would still own some of that. So, you don't need cash. And I was buying and selling, and back in the 2000s, I'd buy this and then wait 18 months, and then that property would go up in value. And then I would use the equity out of that one and refinance to go buy something else. And I just stair-stepped until the merry-go-round stopped. All of my bankers were my buddies, and calling me up every week, Stewart, what are you buying this week? Because they wanted to loan me money until they didn't have any more money to loan. And it was a foolish way to go about it. These days, we are much more deliberate. We are much slower. Painstakingly slow when it comes to making an acquisition. And if the numbers don't work, and if we can't raise a proper amount of reserves when we're going into a deal, we don't do the deal. Technically, reserves will actually diminish your IRR, because you've invested too much, but nothing will diminish your IRR like giving the property back to the bank. So, it's just prudence,
Really is. You look back on that, like you said, you tell me that story, and there is, 1,000 things come to my mind. I go, $500,000. I mean, could you not have just offered half of your portfolio? I mean, what would you do differently with the toolkit you have now if you had to go back and rescue yourself in that situation?
I would have contacted, every person that I knew of, that could have, and tried to do, find 50 people, put in $25,000 each and so for 500K, you'd get you'd get a $5 million net worth portfolio.
Right.
And I'll say one thing, I was embarrassed by the situation that I was in, and things were moving so fast.
That's true.
In the last half of 2008, there was a presidential election going on. We were looking at July of 2008 when Countrywide Mortgage told people on July the 27th they weren't funding loans on the 31st. And we'd seen the year, well, Bear Stearns crashed that year.
Right.
That doesn't mean anything. So I will say I left that and sort of have built a career, because I'm a fractional CFO, out of helping companies that are in cash crisis. And so I sort of got my chops going through my own crisis, if you would. And now I'm just a stoic person that faces whatever comes down the street. Yeah, well, okay, been there, done that. And then you just sit down and you tell people the truth and say, this is what I can do. And so I've helped a lot of companies through manage crisis, not just manage the decline, but manage their way out of a crisis and then back out of it again. So.
Right. No, that's a great answer. I certainly appreciate that. And you're right. You forget how fast things were moving at that point.
It was unbelievable.
It was lightning speed. And all of a sudden you're like, wait, where are we now? The world was changing in the financial markets minute by minute.
One little statistic. I pulled a financial statement for a bank for June 30th of 2008. It showed me with a net worth of over $10 million, all based upon appraisals. And
sure.
So no funny business there. 90 days later, I was probably underwater $5 million just from the change of asset values. Because what's real estate worth if the bank won't lend on it? So, debt and real estate go hand in hand, and it's a great lever, but that's how fast it changed.
Right. That's a great point. I'm curious because the one thing in this equation that I haven't quite wrapped my own head around, and maybe you can help me clarify the thoughts on this. Debt and real estate go hand in hand, yes. And as we see the price of money rise, the valuations are going down. We're seeing some of that. Yep. But yet at the same time, we are printing just an absolutely unprecedented amount of money in the history of the world right now. So how does that mix in on the inflation side of things, which I say that's going to taper? I don't think it's ever going to taper anytime, in a meaningful window for the rest of us. But you do that, and it seems like valuations would still just have to continue to climb. How does that work out? If I can even generate an intelligent question.
I'll give you an unintelligent answer. I can't give you the economic answer, but with the inflation, asset values will have to continue to rise, and as asset values rise, everything else rises as well. So they're flooding the economy with easy money.
Right.
Right now, and I say it's Republicans and Democrats and all of the above, and all across the globe. They're doing it in Europe as well. So asset values are going to rise. So actually, inflationary times. I've got an ebook coming out on this. Inflationary times is a great time to buy real estate. And why is that? Because asset values go up. Asset values go up generally over time anyway. But when you've got serious inflation going on like we've had here for the last 2 years, you buy real estate, but you fix those dollars for your debt. Mm-hmm. So buy a $10 million building, you're going to borrow $7.5 million of it from a bank. Inflation goes up, say it goes up 10% a year or whatever. At the end of the day, you still owe $7.5 million.
Right.
And those dollars may be worth less and less and less, but that's going to be true whether you own the asset or not.
Right.
And so, but the borrowing position is actually becomes your fixed point in the investment, and it doesn't go up.
Right, right. Yeah, anytime you can, as a real estate investor, secure long-term fixed rate debt, that is an amazing inflation hedge. Certainly one of the few tools, I would say, economically speaking, that we have to really fight it in a meaningful way, and that's one of them that is oftentimes
correct.
Overlooked. Let's talk a little bit about the place that you are currently investing in. I know you're based there in South Central Tennessee, and you are really close to Huntsville. I know you spend a lot of time there in Huntsville. So tell us about Huntsville, why you love it, the market, what's going on there. Most people don't even know that Huntsville is now the largest city in Alabama, which is mind-blowing for me, as I've been driving through there since I was a kid. It's like,
Me too. Yeah.
Hunt's like, wait,
Yeah.
I would have put No, not Birmingham. It's Huntsville. So do, sir,
Yeah.
please carry on.
There's a little bit of semantics to that. Alabama doesn't have any metropolitan cities. So if you go city limits to city limits, Huntsville is the biggest. Now, the Birmingham MSA is still much larger than the Huntsville MSA, but I think that's going to change about 2030, 2035. I mean, there's no doubt there's just massive growth going on here. I'm sitting in Huntsville, Alabama right now. I'm sitting in a building that we purchased December 1st. This is the office side of a self-storage facility that we purchased over here. So we're very excited about Huntsville and why. I've been watching Huntsville since 2008 because this is one of those situations you can point to an event that started the growth of a place. What happened in 2008? Well, the Nonpartisan Base Realignment Commission of Congress, they're sort of a permanent subcommittee, and what they recommended in 2008 was to consolidate 3 Army commands on the Redstone Arsenal, which is the massive military base in the middle of Huntsville. And when they did that, one of those commands was the purchasing command. So everything that is purchased for the United States Army is now based in Huntsville. And Huntsville, the Redstone Arsenal has been a sleepy little research center. It's been the home of NASA since NASA was created. It really hadn't had much going on, and they kind of liked it that it was kind of secret. You didn't have anybody around but a bunch of rocket scientists. But then all of this activity started to come. So and just another semantical thing. Huntsville had never had anything higher than a 2-star general before at Redstone Arsenal. Now we have 3 4-stars. So, and all of the staff and trap come with that. The other thing that happened, even under the Barack Obama administration, was massive additional defense spending, defense research. So Huntsville's been a center for that. Anybody who's who's who in defense contracting has a massive presence here. If they're not headquartered here, they have a massive presence here. In 2012, the Base Realignment Commission reallocated some additional command here. Not as big as '08, but it just kept piling on. So at the beginning of 2008, Huntsville was a town of about 200,000 people. Today, it's about 450,000 in about 15 years. And so just massive home building, massive corporate investment. I haven't even talked about the corporate investment. So Toyota Mazda put together a engine manufacturing joint venture west of Huntsville out towards I-65, where they're hiring 4,000 and actually, it's more than that now. They just announced a couple of weeks ago they're hiring an additional 1,000. The FBI is relocating the Quantico training facility to the Redstone Arsenal. So the CIA has a presence here, but of course they won't tell you how many people they have. They'd have to kill you. So NSA has a presence. Almost every intelligence and defense-related agency has a presence here. Facebook has a major data center here, and the manufacturing and government and private focus on this region is unbelievable. And to me, why I'm here is it reminds me of Nashville 30 years ago. I've spent my entire adult career I should have bought that. I should have done that. And it's like, I'm not letting Huntsville pass me by. I'm getting on this train, and it's not to sound reckless, but there's hardly a bad deal in Huntsville. Now, I mean, we're not doing a lot of them because we are very diligent, but there's a lot of people that want too much for the property. But if you work it as we're supposed to do, then there are good properties around. I should have said there's no bad properties in Huntsville. That's what I should have said. A lot of bad deals.
Sure. I don't think we'll ever be without bad deals. That's really intriguing to see a city grow so rapidly with so much investment, both from the government side of things, but also from the corporate side of things. Yeah, that's absolutely incredible. What would you say, if I said the term that 2023, I think there's going to be generational opportunities. Maybe that was what you said, generational opportunities coming about in 2023, maybe even or Huntsville and then beyond. What are those, and why do you say that?
I think it's generational because we've got this slowdown going on. Whether it's a recession or whether it's not a recession or whatever. Real estate as well as the markets have been going up so fast and so consistently that it's been very, very difficult in concerning as to where you get into where do you get into the flow. So I use the word generational because now we have a pause, and after the pause, after the Fed says they're stopped raising interest rates, and maybe they have already, or maybe they've indicated that they're slowing down. I think the pause will come off, and good deals will become obvious. People will be looking at fundamentals again and doing good and proper due diligence. And I think it's a great opportunity to get in on some really good assets and watch them grow as the pause is turned back on, and hopefully we move up again in a more steadied manner, because this is the way things move up steady and then they go crazy and then we have a pause. So so you want to catch the curve down here again, and so we're about to have this pause. I'm not seeing any asset price decreases in the markets that I'm looking at. And I think you're not going to for very much in the South because, let's face it, we all acted like the pandemic wasn't real after about 60 days anyway. So we all just kept going back to work and doing everything. So, but I'm not looking for price decreases. I am looking for things to have slowed down. And I think part of the pause will be, there'll be some sellers that will have come to the table and said, okay, so I can't sell my office building for a 3 cap, or even a 5 cap. That's not rational, but they should be happy with a 6.5 if it's got good leases and it's a good asset and all that kind of stuff. So and there's a deal there on both sides. So as the pause will cause the sellers to get realistic about or stop being sellers and leave the market, and that's okay too.
I think you're right on that. And that's one thing, you've heard, or I've heard, certain predictions, that's all it is that, they have a massive, price decrease and this and that and the other. And I go, gosh, just from a simple supply, the thing we talked about early on in the show, the simple supply of dollars in the market would indicate that prices can't go down. They might, right. And so I like the way you've put that, a pause. It's like, okay, we might see, I don't know that maybe we'll hit a recession, maybe we won't, maybe we'll just hit stagnation, which is kind of, I think, in keeping with that pause idea that, okay, we're going to just pump the brakes for a little bit and coast, but catching it in that pause, I think is a really important way to.
Yeah, that's the generational opportunity, is catching the pause.
Right.
They come along about every 10, 12 years, something like that. And,
boy, don't they? Yeah. I look back at 10, 12 years ago when I was buying real estate at the foreclosure auction, and I'm like, that's when I got into real estate, and I didn't know it. I didn't know. I didn't have the previous to that point in time experience to look back and go, oh wait, like I'm the only guy at these auctions. I'm the only bidder at real estate auctions, and I'm paying $1 over opening bid and I'm winning the bids. Like, I didn't know I was in the middle of a pause. Boy, if I could go back to myself now and say, hey, dummy, keep buying. Cause it's never, not for a long time will you see prices like this.
Yeah. Warren Buffett, I guess, said, you want to buy when everybody's scared.
Right.
And then when everybody's happy, you want to sell. That's a paraphrase, but when everybody's just giddy, it's time to get out. That's it. People are scared right now, and I think we're going to find out in about 60 days that the Fed will announce, or whoever, says, oh yeah, we had a recession. It was last. I think we're past it. I didn't catch when they changed the definition of a recession. Anyway, we had 2 consecutive quarters of declining GDP. At the end of Q2 last year, it's like, it didn't stop us. Recession, not recession, interest rates, we're cash flow investors ourselves. If we can get our cash flow margin that gets to an appropriate return, we're buying. I'm agnostic what the interest rate is. Right. This doesn't feel like a recession to me.
Right. I love it. I love your thoughts there on how you're buying and why you're buying. That's something we just closed on an RV resort in December. And for most people, this interest rate sounds absurd. It's a 7.5% interest rate for 10 years, right? I mean, compared to the terms of, yesteryear, that's like, oh my gosh, that's astounding. But we bought it at a 15 cap. And it's like,
there you go. Yeah.
Whatever. Whatever. My spread there is absurd. So thank you.
Right.
I'll take that
Exactly.
7.5% interest rate. So
yeah,
kind of funny how just a little perspective.
And you'll improve that with management. And, there's a reason it's at a 15. So
correct. Oh, absolutely. Absolutely. The operational upside is almost unlimited. So lots of fun to think and look at things like that. Stewart, I have certainly enjoyed having you come on the show today. This has been a blast. I've loved hearing your thoughts on, just everything from the recession, the lessons you learned in 2008, how you lost and then built back your portfolio, the things you're focusing on, your thoughts on how you buy for cash flow and assets like that, your love of Huntsville. I don't think you're wrong. I've certainly watched that city go nuts. And then just also, the discussion around generational opportunities that maybe we're going to find here in 2023. This has been certainly enlightening and insightful. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Best place is our website, harvardgracecapital.com. You can get a link there to book some time with me or look at some of our resources. And do not hesitate if you want to call me up and tell me I'm crazy. I love talking to anyone about real estate pretty much anytime. So I just love it.
Fantastic. Stewart, thank you again for coming on the show today. Have a great rest of your day.
Thank you. Thank you so much. Appreciate it.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.